Hello and good afternoon, everyone. This is Kristina Kuprina coming to you with the update on the economy combined with a PowerPoint I originally was going to do live and in person later this year. And it's all about the behavior gap between our life decisions and our financial decisions. So I hope that everyone finds it enjoyable and great fun and thought-provoking and introspective. It's also something easy to share with other family members, younger and older as well as friends. I'll start the first half out though with the updates on the economy, kind of where we're at. I'll keep this briefer today only because I want to focus on the PowerPoint and the behavior gap component. But the economy is very important, and I know that's what a lot of people look for. Know that if there's any more information you want between now and the next one in 2 weeks, in which I'm going to talk entirely about the economy for the second half of 2020, so that's really going to be deeper into the economic side of things. That'll be in 2 weeks. But of course, if anything I say today triggers a question, or if you have questions that aren't answered today, please don't hesitate to reach out to me. You don't need to wait 2 more weeks to get the answers. For those of you that are newer, I know most people now are doing this, signing up and getting the recording later and not actually able to attend the time that I'm doing them. So some questions I've received in advance. However, if you have questions about anything I say or even questions before I speak, please put them in the Q&A box and I will do my very best to answer every one of them. As I like to keep this as relevant as possible to the people who are listening here today. So I wanted to kind of touch upon a few different areas. Some of what I'm going to plan to talk about today has also come up in the questions that I've received. And I'm going to kind of talk very briefly and high level about where we are with COVID and the virus from a standpoint, as everyone I'm sure knows at this point, there was a resurgence in cases. And it has caused partial to various levels, I should say, of shutdowns and rollbacks of reopenings throughout the country. So for the purpose of this today, I'll touch briefly upon where we are, I guess, COVID related and how that may impact the economy, how it is and may impact the economy, and then jump into it. So yes, there's been a lot of rising cases across many areas of the country, some areas much more than others. Again, this is probably known to everyone at this point. The thing that's most important to keep in mind is that while some of it is increased testing and some of it is new transmissions, the death rate as of yesterday or maybe this morning's data in the United States is 0.03%. Globally, it is 0.04%. This is of unknown cases. Okay, obviously I think we all know there's a whole lot of people floating around there that have it or have had it and have no idea. So of known cases, our death rates have plummeted significantly both in the US and overseas. And this should be comforting to hear because in the beginning the numbers were feared to be far worse. However, because of the spread and because of caution, various governments and cities and states and municipalities around the nation are rolling back some of the opening that had happened a month or two previous. And this does have an economic impact, and we're watching this very closely. As of all data as of yesterday, all that has happened is the growth has stopped and flatlined. This is very important to know. The growth has stopped and flatlined as people are trying to figure out what's next. We have not seen a decline, just the growth and flatline. This is collective data. Some parts of the economy, of course, are doing much better than others. And some parts of the economy are actually slowing a little and others are shooting upward. And they're not maybe the areas we would think of that are starting to see this resurgence. And there's things just bubbling up right now that I'm watching very closely that is really going to kind of shift who's doing well and who's not doing well in this environment. It's expected that, as the case loads are now starting to decline, and of course deaths follow. We still have that low rate of deaths, but deaths tend to slow after the case level. We're watching that very, very closely to see, because again, we're looking at 7 and 14-day moving averages, smooths it out a lot more than daily totals. This is important from the economic standpoint because based on how this happens, cases declining, cases lowering, will determine on how the reopening or continuation of opening goes from here. All of this doesn't too much impact the economy at this point because the closings have been targeted to a relatively limited area, and a lot of things that were closed before were given opportunity of doing things differently. For an example, restaurants allowing to have outdoor dining and whatnot. But these are things, watch it closely to see how that plays out. High level. So today we got the big juicy piece of data that we were all anticipating, and not in a good way, which was the second quarter preliminary GDP numbers, which were awful, below 30%. These are only preliminary numbers. It will be revised within a month or so, but we did expect it was going to be this bad. Every estimate I'd seen was somewhere in the low to mid 30s to the high to mid 20s. So we were right pretty much in the middle of that with the preliminary data. It doesn't matter actually a lot because this was expected. We all know everything was shut down almost entirely for the second quarter, and these numbers would be really pretty bad. Technically now we are in what's called a recession. Why is that technically the case? A recession by definition is 2 consecutive quarters of negative GDP data. So the first quarter, when this all kind of begun, came in at -5. Now the second quarter we have the preliminary data. But here's the news. We're only 1 month into the third quarter at this point, and we're already seeing meaningfully growth. If we continue on even at a flatline basis, this number, please understand, changes almost weekly. We're targeting a double-digit GDP number for the third quarter. Now that would sound like stupendous in ordinary times, but remember we're coming off a pretty bad quarter. So we have a long ways to go yet. But the good news is that the third quarter at this point almost certainly will be far, far better than the previous 2 quarters. And it has almost everything to do with the level of stimulus that has been put out, both by the Federal Reserve initially. It's stupendous. You've heard me talk about this before. I won't beat you up with it because I'm still amazed and impressed with what they did from an economic standpoint. But also the federal government's continued willingness to add a lot of debt and support a lot of programs. As we speak, they're negotiating yet again for the next round of stimulus. It almost certainly will happen. Yes, they will argue. Yes, they will debate. It never is a fast process. This is an election year. There's a lot of posturing to be done. However, it will get passed. Why? It's an election year. Nobody from either party wants to be the one, well, I shouldn't say nobody, there's always those outliers, but for the most part, they don't want to be the one that's not helping to stimulate the economy and help people that are suffering during this time. If anything, there may be an expansion on some areas that didn't reach all of the intended audience. There is a good possibility, though, that the $600 additional unemployment will be reduced, probably not that low. The Democrats put their number out, the Republicans put their number out. Theory would be it will end up somewhere in the middle. And that number, well, yes, I can see both sides to it. To pay someone significantly more not to work than to work does have its own moral hazard. However, it also is money that is being put into and used within the economy. It is money that is allowing people to maintain mortgage payments and rent payments, food payments, and the like. So there are arguments to both sides, and I would imagine something will be worked out with that. However, the challenge of this, and I want to bring this up because of the economic side of it, the challenge is that many states, unemployment systems are so antiquated, California being probably the top of those, that last minute changes to any payment program take some time to actually program into the system. So the disruption is that one party wants it all in one package, and another party wants to kind of push through just that one thing, just not to interrupt the unemployment payments, and because they're so critical to the people receiving them. I'm not sure where that's going to go, but the fact that it may take some weeks for them to negotiate this package out, that one component, if not done separately, could create some volatility within the markets and the economy around the uncertainty for these people and the money they're receiving. Please understand I speak as an economist here. It is not because I don't have deep compassion and understanding for all aspects of how this is impacting people, but you've come to listen to me today for the economic component, so I'm going to focus on this from that perspective. Another important part of the stimulus that is actually bipartisan, so it will almost certainly happen, is an extension of the PPP loans for businesses. As a quick refresher, the PPP money was money that you could borrow provided you spent it for payroll, for rent, and things like that. And they've continuously adjusted the program to make it easier to use and give a lot more flexibility to it. But this has been a lifeline for many of the businesses that have been closed. However, it's really only about 5 weeks of money. And as everybody well knows at this point, this is taking far longer than the 5 weeks. There's billions of dollars left in the program that is still unused. It's very easy to open it up to allow companies to go back in and take a second round. And that almost certainly will happen, which will greatly help the businesses that are affected right now by the continuation of shutdowns or the reemergence of shutdowns in certain sectors. So that's a positive thing. There are many more things that are being debated. The stimulus check, it's coming back. It's also bipartisan. Few details not figured out yet. However, it's coming back. All of these things from an economic standpoint are very, very important to continue to help the economy go in a time in which many people are being very cautious and many things are closed down. I also would like to touch upon another kind of important part of all of this stimulus. Please be mindful of the fact that the news media does kind of sometimes focus a little bit on the worst case scenarios more than the best case scenarios. And we will be hearing a lot about, oh, it's falling apart, oh, it's not coming together, and the markets will react accordingly. At this point, the highest probability is it will come through. And again, this will have an impact during this time. So those are the kind of the main areas I want to talk about. Earnings season is upon us. We're right in the thick of it right now, and some of you who are clients have probably noticed I'm making changes. If I'm not, there's not yet time to do so. What's important about this earnings season is the second quarter, when we got the earnings from the first quarter, we really gave companies a pretty wide pass at the fact they couldn't give us much guidance about what the future would bring because nobody knew. In April and the beginning of May, when most of the companies report, nobody knew. And thus we couldn't get the most important tidbit that comes from most earnings reports, which is future guidance. So companies were given kind of a free pass. Whatever they said they did in the first quarter, nobody cared because that was definitely not happening in the second quarter. And what they guided to the future was so uncertain that we really couldn't take it that seriously, and most companies actually didn't even bother. So they sort of got a pass. So we really have not gotten guidance from companies since last year about how they're doing and how they will likely do in the future. So this earnings season is so incredibly important because there's a big dispersion, as I mentioned before, between companies that are doing well and companies that are not doing so well. And I'm talking about large publicly traded companies for the purpose of this. And there's tremendous amount of differences, and we're just begun in the season. It's very, very important to see it though, because there's a lot of things popping up that were not seen or known to us before, but are providing amazing opportunities regardless. Even if we stay flat for the rest of the year, we don't get tremendous growth, which is unlikely that we won't have growth, but theoretically possible. There's a lot of companies that have still managed to find ways to succeed in this environment. So that was kind of the high level. I'm on the earnings. Again, please give questions if you have specifics about that. I want to, because I'm going to go over the questions that I got here because it'll tie into some of the things I didn't already talk about. I always get the hard questions here. Okay, here we go. Give me some more easy questions. How will the upheavals affect the markets, the protests, the elections, if Trump doesn't step down? The markets will not be affected by a lot of this as long as it doesn't seem to have an economic impact. It gets a lot of attention in the media, but the media again tends to make a lot of noise about things. I'll address each one separately. From the viewpoint of an economist, I understand there's a lot of ways of seeing this as well as a lot of viewpoints. So from an economic standpoint, the protests have two components. They have the peaceful protests that are widespread and for a very good cause and a very important cause. And those don't really have much bearing on anything. This is part of America's history. It's one of our rights, and it's something that is generally celebrated even if you don't agree with the cause. The other component is the shutting down of areas of cities, the destruction, the rioting, the lootings and whatnot. This does have an economic impact because if people don't want to come into town, what few businesses are open will suffer financially, as well as the cost of rebuilding any damage that's done. And again, fear of people coming to these regions. So we're watching this closely. It's hard to tease out how much is related to that and how much is related to overall COVID-related concerns. But it is something to watch and to watch closely over time, but it's unlikely to have a major economic impact. The second one, elections. In not the next webinar, but the webinar after that, I'm going to talk all about elections and the economy at length. The reason I'm waiting out that long is I would like to wait for the Democratic convention to take place so we can get clarity on what Biden's platform is. I will tell all of you now I have a very distinctly different portfolio plan for Trump being reelected than I do for Biden being elected president, as well as some adjustments made based on the makeup of the House and the Senate. Purely economically here. I know I've said that a lot of times, but I just know it's a sensitive subject for so many. And it will be a very different market. And I'm going to save that, though, the election aspect for the other one, because I'd like to explain why I'm saying what I'm saying, so each person can, kind of come to their own conclusions. Trump doesn't step down. We have a system in place if that happens that is very effective and efficient and quick. I'm not really thinking that's a high probability at this point. I think it's more of a, he said what type of thing, as the media usually does. And I'm not picking on the media, but maybe I sort of am. There's a system in place for that. And if I want to look at this economically, I look back at the 2000 elections, which really put the market into a tailspin. And that was around, remember the hanging chads and Bush-Gore election? And oh my gosh, the system didn't work. We don't have a president. Gore's not conceding. What's going to happen? And there was a process. There was a process in place to recount the votes, and it went all the way to the Supreme Court, and it was decided, and Gore conceded, and life went on. And very much the same thing will happen here. And if it goes beyond that, there are systems in place. It would, whether you like or hate Donald Trump, doing something that foolish would destroy his entire legacy. And not just the legacy of his presidency, but the legacy of his past and his future as well. And he wouldn't have support even from his own party to that measure. So I'm going to go with it's highly unlikely. He likes to stir the pot, and that's where I'm going to leave it at this point. Maybe I'll leave it with a funny story. So a portfolio manager that I greatly admire, who's very, very thoughtful and very wise, used this description back early on in Trump's presidency when he would tweet things and everybody go crazy, especially even the markets. And he said that Donald Trump's tweets remind me of something. When I was a young boy, my father used to take me to the fish farm. There's a fish farm. And at the fish farm, there was a coin box. And you put in a quarter and you get fish food. And then you could go out to the ponds and throw the fish food in, and all the fish would come up to the surface, feeding frenzy, And so he said he sees the tweets, and not just from Trump. There are plenty of other people that tweet stuff like that as well. I don't want to show as I'm picking on anyone, but his tweets are very much like the chum thrown in the water, and everybody reacts to them. Many of them don't manifest the way that people fear. And so again, we will watch that, but any disruption in the markets will be very, very temporary. And again, there's a system in place for that. Okay, hard questions over. Is gold a good investment? Depends. It depends. There's pros and cons to it. There's a very valid reason for having it as an investment for certain clients in certain situations, but there's also a lot of considerations about it. Is it the right place to be? This is something I strongly recommend talking to either myself, or if you do this on your own advisors, and see if it's suitable for you. For many clients and many portfolios, it does have a place, but not everyone, and that's an individual conversation to have. Okay, what to invest in now? I can say I can't give any investment recommendations in a public forum. You've heard me say this before. This is an individual conversation. But let me give you some examples on a very high level of spaces that I like. There are plenty of technology companies as well as traditional companies that are looking at ways, already active in ways to optimize our supply chain. These are really, really good opportunities. You have to know what you're looking for, because there's also a lot of nonsense out there. There's a lot of things in the alternative energy, and I say alternative energy outside of fossil fuel space. Some will never see the light of day, and some will likely be transformative. A lot of opportunity there. The validity of a lot of this investment may depend on our leadership going forward and where they focus their attentions, but there's a lot to be said there in that space. Another one, which is something that I find quite really valuable right now, which is, sounds boring, but it is air filtration systems and the companies that make them. I'm going to maybe not use the correct terminology here, so anyone who's an expert in air filtration systems, please have kindness and mercy on me. There are a level of, I believe it's HEPA level filtration systems that filter out viruses and filter out all sorts of contaminants and pathogens and bad stuff floating in the air, and much more than a virus. There's so many things that make people ill, from allergies, from molds and the like. And there are high-level filtration systems that can be installed and used that can certainly filter out a coronavirus, but other things as well. And a lot of the airlines are looking very closely at this right now. Cruise ship companies are looking very closely at this right now. And I would imagine, actually, I'm not going to just say imagine, I know for a fact that a lot of buildings, large buildings are looking at this, large workforces are looking at this, and this is beyond COVID. So now you could have a safer environment. Why are we allowing restaurants to be open but not for indoor dining? Why are we allowing stores to open but not malls? We're trying to keep people not being congregated indoors in close environment because it shows that it can increase the spread. What if you can create an environment that is overall safer for the people there? The workers, if you're a company, the guests or customers or clients, if you're a business. And so that space is a really important space to look at. The only thing stopping it from exploding at this point is that if there's not a government mandate saying if you have this type of filtration system in, you can remain open, you can keep doing business. That may come with time. But beyond COVID, it's also something where people are going to want to feel safe and healthy even once there's a vaccine or a treatment. So there's a lot in that space. Again, a lot of speculative nonsense and a lot of really good investments. I'll stop there because this could take up this entire hour, because there's a lot of really interesting things out there right now that I'm looking at. If you are my client, please let me know one very important thing. If the volatility in March made you highly uncomfortable and you have not already told me this, please let me know, because while we're up is a good time to make adjustments to minimize any shakes up and down that we might have. Even short-lived, I want to make sure everybody sleeps well at night, because we have enough to worry about, and it's very, very easy for me to adjust the portfolio appropriately. I have this conversation with you in depth, but sometimes actually the experience is the thing that really brings it crystal clear. So please do let me know if you want to do any changes. For everyone, what you invest in so matters on your time horizon, your risk tolerance, when you need the money. It could be the best investment ever. You could make a fortune at it, but if you have to sell it at a bad price because you need to or want to do something else with the money, then you lose and you can't recover that money. And I'll actually use a stock as an example here. Many of my clients and I have been investing in Tesla stock for years for appropriate clients that were willing to take the risk. Okay, it took a long time for that stock to do well, and it had a lot of significant drops before it got there. So it doesn't go up in a straight line. There's always risks. So please, before making any investment in anything I talk about, talk to somebody. You're a professional. To me, I'm totally welcome. I'm totally willing to talk to anyone just to give you a high-level view. Last one here. What will happen to real estate? I need to get a real estate speaker on this because I get this question all the time. Real estate is really interesting. And again, there are experts, and if any of them are listening right now, feel free to type answers in. If not, I will just give you a high view because I'm just using Case-Shiller data, and I understand real estate is all about the location and not about the broad picture. In certain markets right now, real estate is absolutely exploding and on fire, and the sales rate, I guess for lack of a better term, or houses in escrow is stupendous. We will see that data post in when we get the July data in August, but we already know by preliminary data it's doing really well. The major trend is people moving out of dense urban areas into more suburban or rural areas. Where they're doing it and how they're doing it it depends. A lot of that is people feeling that they have more flexibility in where they live and work. A lot of it, or some of it, is to do with being out in a place where if they have to shelter in place, it's a little more pleasant than a tiny apartment. There's a lot of factors in that. A big one, from what I'm hearing, is people just rethinking their lives and where they really want to be. So houses in desirable areas to live, not close to work necessarily desirable, those markets seem to be doing very well. In addition, this is a second wave. It's just starting to burst forth. It'll burst forth more when people start doing taxes over the next couple of years, going from high tax states to lower tax states, especially if you can be remote. That's a big deal because there's a big difference between tax rates, and they're going to get higher. I can tell you in California, our governor's made that very clear. Our taxes are going up. He makes no bones about it. Don't know what that looks like yet, but it probably won't be a good thing. So that's kind of the second wave. Real estate is highly localized, and there's a lot of considerations about buying and selling real estate that should be taken into account. So I cannot stress enough to speak to your financial professional to make sure what makes sense with you. And I'm not advising or recommending this. This is important that you must talk to the individual that is advising you, your advisor or myself. Something that's done now more often than not is things called security-based lines of credit, which gives you an opportunity to borrow against a portfolio to make purchases or to use the money for something else. It's like a line of credit. I am not advocating for this. I'm not saying you should do it, nor am I promoting it. I'm saying that that's an area that people are touching upon right now while the interest rates are low because of the flexibility of not having to go through the lending process. It's also not designed to be a long-term, but more of a bridge loan type of strategy. But that's, again, expanding people's worlds. And the final thing about real estate, it says it's highly personal, is you really do want to know how long you're going to live there, because that says a lot about what kind of property you're going to look at. But overall, the numbers are very strong in some markets. There are some markets where things are weaker, but we don't see any areas that are like free fall collapsing right now. Rents, on the other hand, are dropping significantly in some of the urban areas like San Francisco, but we're not seeing that widespread yet. Again, if you ask me specific real estate questions and send them in advance, I will talk. I'm fortunate enough to have access to the people that can answer them in more detail. So if you give me the specifics, I will get back to you with the actual answers. Okay. Are you familiar with the question? Are you familiar with the Dow versus gold ratio? If so, is it a value? Yes, I am, and not really. It's the concept of it is sort of trying to determine the value of gold in relation to the dollar, trying to gold relation to the value of the stock market. The problem with the value of the stock market is it's constantly changing based on other things, where gold is a little bit more fixed. There's a lot more to it than that, a lot more to it than this. It's just another tool in a toolbox, but it wouldn't be a decision for making an investment in there. So that being said, those are all my questions. I don't have any other ones that have popped up here, so I'm going to jump over into the fun part. If any more questions come up when I'm doing the next part, I'll do my very best to answer them. And if not, feel free, again, to email me, to reach out to me and whatnot. Overall, on a high level, and again, I'll talk more about this in 2 weeks, the economy is flatlining. We're watching closely for any major declines. We're not yet seeing that, and we have literally real-time data that's coming out to me daily, so it's able to watch and see as opposed to just looking at backwards-looking data. At this point, finally, this is to be expected when we're shutting things down and there's a bit of uncertainty around it. Expect, as I've mentioned earlier, that we're going to have the big shock up and down days here and there, but overall, provided we continue to backstop the worst of it, we will likely get through this time. I guess I will touch upon one final thing, because that was sort of part of a question I skipped over, which is about the virus, the vaccine. I don't know any more than anybody else here, and I don't want to guess on when that will be. The only thing that caught my attention on that was Dr. Fauci, who, I hope I'm saying his name properly, who is a very, very conservative and cautious man by anyone's measure, did say that he expects that we will likely have one, and I'm probably not using his exact words, anticipates, expects, by fall or winter, which was a lot faster than I would have thought. In addition to the fact that he probably has some information, since I'm sure he's watching it closely and he actually understands what he's watching, as opposed to myself or many others with opinions. So we could well have a vaccine sooner than maybe originally expected. That would be, of course, very, very bullish for the markets, and people will become very celebratory, and certainly will change things quickly. People will get more confidence perhaps to go out and travel. Unfortunately, though, it will take some time to vaccinate 340 million people, and that's just assuming that we're the country that develops it first and we don't have to wait in line. So if everybody jumps out and starts going back to life as normal, tear off the masks, hug one another, kind of back off on their caution, then what may well happen is they will go and potentially increase the spread of the virus by the fact that they're going out and doing all these things. So then you could potentially see an increase in cases, a decline in the markets of the economy for a period of time as they shut down again, and that is a risk that we are watching for. Thank you. Sorry, I have no idea how that happened. I'll just, all I mentioned with the virus is that if a lot of people start to feel safe again and feel like it's over because we have a vaccine, but yet they're not vaccinated and they go out and go back to life somewhat at normal, we could see an increase in cases, an increase in spread, and potentially another shutdown, and it could have an impact on the economy. We'll watch. We're way too far from that, but I do want to bring that up because I did get some questions around the vaccine. And thank you for people telling me that the microphone went out because I'm so busy focusing on you, I don't really watch the rest of the screen. With that being said, I'm going to jump over. I want to do it the 30-minute mark, and we are there, to the behavior gap. This is a presentation that I had, and the large reason I did it was a fun event to do with a little bit of food, a little bit of wine, and kind of rethink the way that we think about money and the rest of our lives, and kind of see some of it's a little funny, some of it's like, ooh, yeah, you're right, makes you think. There's a lot to this. This is designed to share with your younger family members, your friends, other people. So when you get this recording and people don't care about the economy, tell them to start watching about roughly the 30-minute mark, and they'll get this part of it. I also use this with younger people sometimes, and it's been, I've modified it a bit, but it's been just a fun way of seeing money, for a lack of a better term. But there's a lot of relevance to it, a lot of importance to it as well. So I thought I would do this in two separate parts and see what everybody thinks. I would love to get your feedback on things like this, as I may incorporate other similar things in the future if it's popular. All right, so let me do the whole share screen thingy. This is the behavior gap. Simple ways to stop doing dumb things with your money. I may want to rename it something that's not dumb things because it does sound a little insulting, but it's one of the things that we can all go, stop our heads and think about sometimes. So I will skip past the disclosures because y'all got to watch that when we started. Oh, that's our team. For those of you who haven't ever seen the whole pile of us, that's our team outside the San Jose office. Okay, I'll start with the emotion. So there's three parts to this. The first one is the emotion of money. Okay, so I love the drawings. I'm actually going to put my notes here because it's easier, and I'm going to go into this in more detail. So money, as we all know, has emotion to it. Money is just not this cold-hearted thing that's on a spreadsheet, a bank statement, in your bills or anything like that. It's not numbers. It's not accounting. It's not, just a material item. There's emotion attached to money. Why? Because we all grew up around money. We all have a different relationship. It's based on our family's relationship with money, our friends, our places we worked, our life experience. So there's emotion to it, which is why many people see money differently. Some people wish to obtain a lot of it for reasons beyond the need, and other people hate money, push it away, just don't want nothing to do with it. It's icky, it's bad. Those are the extremes of this. Within the middle, we all have an emotion attached to money. I have yet to find someone who doesn't have it in one way or another. I'm leaving the notes there at the bottom because it kind of ties into what I'm seeing, what I'm saying here as well. Often when I meet with clients and we talk about money, and it's a couple, there'll even be some different versions of certain things about money. And it's not a right or wrong, it's just the relationship that people have around their money and the emotion. This is a fun one. So this is the wheel of madness. And I call it different things. Also call it the spiral of madness, but the wheel of madness is figuring out the difference between what you need and what you want is one of the toughest challenges in personal finance. Need, want, need, want. Those of you who've heard my 3-bucket of spending process that I do with many clients in financial planning, I always ask what's essential, what's necessary, what's discretionary. And that actually involves a lot of thinking, a lot of talking. So if you look at this, that's nice, I want that. I need that, I must have it. That's nice, I want that, I must have it. Repeat until happy. But you see the question mark there, right? The question mark is there's the obtaining, there's the having, possessing, and then is that feeling still there of needing and wanting? Is it constantly another conquest, another mountain to climb? Why are you obtaining these items? And there's no right or wrong to this. There's a lot of times there's judgment where people say, oh, that's not important, that's not necessity. Why is he wasting his money on that? Right? It's all a matter. What is it does it bring you joy? Does it bring you happiness? Does it bring you purpose? Or are you just filling holes in your life? And we'll get into that a little bit more later. That's a thing to think about, that thing you need. When I do financial planning for people that, that are new to money, maybe just coming out of an abusive relationship, or just starting out in life, that had a lot of challenges and aren't used to making financial decisions. I do this as a part of my volunteer work. And one of the things that's always trying to decide is that need or want. Need or want. It's more challenging you think. When you get to a certain level of money, you can obtain more and more of what you want, but what you need may have not necessarily changed. It can get very, very deep. Spending your way to happiness. If you look closely at this, okay, spending your way to happiness is not spending money, it's spending time, spending resources, all the like. So the things that are most valuable: time with people you love and care about. Unfortunately, can't get too close to them right now, but time with them. Experiences, and your freedom. And you will probably know this intuitively, if not actually, the more debt, the less freedom. It's just the reality. The more debt, the less freedom. The more obligations, the less freedom. A significant portion of my clients, regardless of their financial position, are looking to simplify their life, especially as they head towards retirement. Why? Not because they don't want to do a lot of fun and cool and interesting stuff. They do it because they want to be able to do it when they want to do it without worrying about it the rest of the time. There's a big difference between buying that house in Hawaii because you really like to go there and renting that house in Hawaii when you wish to visit there. Same experience, different level of responsibility. And there's no, again, that's no judgment. There's no right to wrong. It's really understanding the whys to it. You notice the bottom, the useless plastic crap. Many of you have heard me say this before. Experiences appreciate over time. Whether it's a place you visited, whether it's an experience you've had with your loved ones, watching your children grow up, whatever those are, those experiences appreciate over time. The older you get, as you relive them, they appreciate. Stuff depreciates. Yes, there's exceptions. There are very expensive cars and paintings, and yes, there are stuff that does appreciate. And this is very simplistic. Stuff you create is actually a whole different story, but stuff depreciates over time. If time permits, I'll tell you the iPhone story on that one. But spending your way to happiness is really big. Okay, this comes down to when I talked about simplicity. Stress is when big decisions merge with uncertainty. Okay? Now, I'm going to use an example that has probably been the case for most everyone that's listening to this right now, and if it hasn't, it may well be in your future. Buying a house, especially your first house, okay? There's not a single person out there, unless their parents did it for them or they had a great deal of wealth, that wasn't a big step in their lives, right? Because a big decision merged with uncertainty. In the middle of that is stress. So anytime you have to make decisions with a lot of uncertainty, it creates that level of stress. So minimizing it by creating a process around it and clarifying what is the most important thing that you wish to accomplish, and doing it like a pyramid. What's at the top all the way down helps to clarify that decision, helps to eliminate a lot of the stress. And this is not only about money, it's actually about life as well. Important financial decisions and giant piles of complexity. Oh my gosh, this is exactly why we love doing financial planning. Financial life is complicated, but it's also as complicated as you make it, right? We want to simplify, we want to organize, we want to eliminate the compartmentalization of so much of our lives. So many of us compartmentalize parts of our life, and even within our financial lives, we compartmentalize these decisions. It all should flow together for the whole. And that is, as you already said, what financial consciousness is. It's that awareness and understanding of how your financial decisions impact and fit within your entire life, and what is most valuable and important to you now as well as in the future. It's very, very important. But that low-grade headache, that's just when you have that giant complexity around that important financial decision. And that leads to a lot of stress and sometimes not the best decision making. But if you can find ways to make it more simplified, more organized, there's 3 ways to do it, and I can share those with you. But the pyramid way I discussed of prioritization is one really important one. And often what happens when you have this
is you don't make decisions. You kind of put it off. You don't want to deal with it. Oh, I don't want to figure that out. I don't want to figure out how to rebalance my portfolio. I don't want to figure out what I should, because it's just, if it's not urgent, and then a life event happens. I'll tell you where this comes up a lot. Estate planning, doing your trust, dating your trust. Wow, who wants to talk about that? Death and disability and illness, and who's going to get my stuff when I die, and who's going to get my organs? I mean, Advanced Healthcare Directive, they ask you a lot of serious questions with that. Not anyone's idea of fun. So it gets put off. And hopefully not until the unfortunate and unthinkable happens. But that's a large part of the reason. There's, again, ways around that is biting it off in small chunks. When clients come to me and they don't have a trust or estate plan, I actually can help them with almost all the questions the attorney is going to ask them. So they have plenty of time to think about it, and they don't have to sit there in the attorney's office or nowadays on the Zoom call trying to decide who's going to raise their children if the unthinkable was to happen. I mean, these are not decisions you want to make with an attorney staring at you. Okay, next section, the role of money in our lives. Okay, so I touched upon that one. Okay, we all have personal biases around money. I mentioned that in the beginning of this. So what money means to one person is very different than what it means to another person. And this is very common when I do premarital financial planning. I used to say for young couples, but now I'm doing it oftentimes when people are having their second marriage, because what's a really uncomfortable thing to talk about with someone that you deeply love, and especially someone you plan to get married to? Money. But it's an important thing to talk about, even if you're going to keep your finances separate because of your relationship and understanding your belief system. And so since it's an uncomfortable thing to talk about, often they come to me as the financial planner or financial advisor, and they see it as you're kind of a referee. And I can talk about it in a way to bring everybody's, thoughts, needs, and ideas into account. And I also can touch upon the least comfortable ideas, which is a very common in a second marriage, is the children are getting some of their money. It's not all going to their partner. And that's something that definitely can be a sensitive topic. I bring that up because the views of money are different, and we can never assume that our views are shared by somebody else, even if we think they're just common sense. Just common sense, because of the relationship each individual has with money. Okay, getting back into the spousal aspect, the spousal chatter. I'll touch upon this just briefly because this is, kind of simple, but understands. So this is, on the off chance this client is listening, I'll be really vague here so they don't know I'm talking about them. The client says, I would really love to have a house by the ocean. Just as an idea, just as a thought. Client's partner takes that really seriously and spends all of their time on Zillow, and has even hired a realtor. Okay. Idea, action. Very different ideas of what that comment meant, and one party took it a lot further than another party. This happens a lot of times. Another area, college, saving for children. Very different ideas. My parents maybe get loans. Our kids are getting their own money. We're not supporting them. I don't want my kids to have any debt. Really important conversations. And the reason is people hear different things and people have different experiences with money. This is why, even if you do your own investment work, a financial planner is a really wise person helping to be a referee in this environment. I'm being very careful. I don't want to toot my own horn here because I know that some people like to do stuff on their own. However, in this case, a third party is a really wise thing to have, help kind of facilitate those conversations. Okay, the want versus afford. Afford is a very nebulous word. We can afford a lot more things than we probably really should be buying, because there's an amazing thing out there called debt. And there's also this thing that we can sort of disregard, which is called an emergency account or emergency savings fund. Life happens. I think we're all really getting that abundantly clear this year for sure. Surprises happen, unexpected happens. Okay, so if you're acquiring without purpose and acquiring without planning, that's when it can become dangerous, because you don't fully understand the what ifs. There's nothing wrong with acquiring. You want to make sure that you're maintaining that balance. You're saving for your future. You're acquiring what you want. The extremes, neither one of them are good. So people say, oh, well, I save everything for my future because I'm going to have a great retirement and my kids are going to have a great college and I have all this money, I save, and don't spend anything. And now someone on the other hand will say, I just live by the moment, I spend as fast as I make it, I buy what I want, and the tomorrow will figure itself out. The middle ground is actually the wisest here, which may be surprised hearing from someone like me, from the standpoint of you don't want to not enjoy the now. Especially, imagine there's things you're going to want to do with your children at certain ages. There are things, and maybe expensive things. There are things you're going to want to do with your partner at certain ages. Perhaps you want to do a big all-out blowout for your mother's 80th birthday. These things are important. They're important milestones in life, and they create the experiences. Just make sure it's not putting everything else in jeopardy. That's where planning comes. But this is a really common conversation, want versus afford. Okay, instant gratification. This one I think is well known enough that I'm going to kind of skip past it a bit, only from the standpoint of really want, buy, and then sort of an empty feeling when you get it. Because it was the wanting that was so much more exciting than the actual having. And that may be a good example is someone that you're really attracted to and chasing. When you catch them, it's not nearly as fun as the chase. Fortunately, I've been married for 28 years and don't have to worry about that, but for maybe some other people, that's more relevant this stage in life. This one's a fun one. Things in your budget, things you value, when they merge together, that's the best. Because you can value something greatly, it's not in the budget, it creates stress. Okay, something you don't value that you could just afford to buy, again, creates an unnecessary feeling of uncomfortableness, of lacking, of dissatisfaction. So that's very important. Make sure the spending's in line with what's truly important for you, not, as I call it, filling holes in your life, creating a distraction, creating something to do, managing boredom. All of these things are the reason people spend, and understanding before you do it means that you will feel more fulfilled with the spending you do and have more money at the end of the day. Your one best financial life is when your goals and dreams align with your resources. This is financial planning. With clients, with the people I talk to that are not yet clients, with people I talk to that may never be clients, I say the one thing that you can do is create the pyramid. On the very top is what you aspire towards. And this is not a values thing. This is just prioritization. What you aspire to, you want to obtain, achieve, accomplish, that thing out there that you haven't yet done that you really want. Doesn't have to be anything about money. In fact, it rarely is. But that's the thing that's not yet there, but you want it. The next layer, second layer, is what you have in your life that you greatly value, that has a lot of meaning, and you wish to maintain or even enhance that part of your life. Could be a loved one. It could be an object or an item. It could be something that you do. It's something really important in your life. It could be a practice of yours, whatever that is. Work on maintaining and enhancing. And the final one, the bottom, is what do you no longer need? What has outlived its usefulness or never really served you, but still part of your life? It's causing you unhappiness, not happiness. So that comes to that. So this adds to the layer to the goals and dreams, that top of the pyramid, with the resources to get there. And this can be planned out. And a lot of times it's a lot simpler and more achievable than people think it is, because when we look at a plan, you can figure out how to do that. Whatever's on top of that pyramid, I want that to happen for my clients. Balanced family budget. I'm going to put on this only from the time that may be right, especially right now, is, sorry, you can't see my finger. So the time, money, and energy. So it's not about the money. If you're so busy running around that you're exhausted at the end of the day. So you have money, you go out, you spend a lot of money, you go traveling here to there to next where your kids in every program known to man. But at the end of the day, you're exhausted and you have no time to do anything else that you value. So the balance is keeping that. The balance is keeping that time, the money, and the energy aligned so that you're sure that you're getting the full satisfaction and quality out of your life. And it gets harder. It gets harder. The more money people have, the more they tend to spend and the more they tend to do. And in doing that, they've lost those other important pieces of their life, which is the energy and enjoyment. All right, here's my part. That, those of you who know me as an investment person, this is the part that I talked about for years in different ways. And it's still as relevant today as it was when I first begun this, which is about how the emotions tied to money and investments I'm going to focus more on the investment side of it. Why being is that everyone knows this saying, everyone knows buy low, sell high, but very few people do it. Why? Because financial decisions are not made logically, they're made emotionally, even by the best and brightest in finance. It's consistently done. So if they're doing it, what chance do you have, right? Well, here's what chance you have to understand a little bit of what drives some of this behavior. Okay, so this is average investor. Okay, I'm going to give my clients pass here because you trust me to do it, so you don't have to get your emotions in it, but you may still be feeling these same emotions when you look at your portfolios, because most of the time you don't actually know what I'm doing. Every single client's portfolio gets reviewed once a month with no exceptions. That is my rule, and I've always followed it. You may not see a thing. Just because I review it doesn't mean I'm making a trade. So you don't know what I'm doing out there, but you're looking at it. Maybe not all of you. Some of you told me you don't look that often, but you do. So you can still have many of these emotions tied to it, just not knowing what's going on behind the curtain. But many investors, they do the same thing over and over again, trying to pick the hottest stock, trying to pick the cheapest fund price or cheapest investment price, trying to do what their brother-in-law is doing, trying to do what the news says to do, this, that, and the next thing. And then they're not getting the results that they expect. And in fact, the results are usually, and there's plenty of studies that show this, below what you would have gotten just to invest in the market itself, in an index, right? Why is that? Because of the emotional component to it, because of the jumping in and jumping out, because of emotion as opposed to logic investing. And even with logic investing, it has to be customized because the time horizon is the most critical aspect of investing, even more important than what you choose. Okay. The perception and the reality of the future financial needs. I want to talk about this for a moment because this is the biggest argument I have for financial planning to each and every person, regardless of how much money you have, even regardless of your age, because it is very rare when I meet someone who has a very good sense of what they're going to need in the future. I'm going to give you a couple quick examples about that. The average person wants to retire in their 60s. My tech clients want to retire in their 50s. And maybe people who really love what they do want to work longer into their 70s if they're able. But I'm going to use the average retirement age, and let's just throw a dart at 65 because Medicare kicks in. Now with longevity increasing, the average American will live at least 30 years beyond that. Okay, not the average life expectancy, okay, because I'm not going to use the median because there's a lot of things that, variations in that as opposed to people with pre-existing conditions and people with other health issues. We have to figure, or you should figure, that you're going to live, a good 30 to 40 years beyond the day you stop working, and that's if you work that long, which is about the same number of years you've been working to save all the money up that you're about to spend. I don't want to use this to scare people because there's a whole bunch of ways to make that happen. A big one is reducing debt loads pre-retirement. The other thing is that the bulk of people out there have saved most of their money in IRAs and 401ks. That money is fully taxable upon distribution. Again, there's some ways to minimize that as well. That's why you talk to a financial planner. So you don't get up to you spend all that money that's in that account. The IRS is going to take a big chunk, 30%, 40%, 25%, depends on your situation. There's ways to manage that as well. But the perception of what people need in their future is very rarely aligned with the reality. The other thing I like to touch upon this is there's no such thing as a retirement number. Disregard those commercials on TV by major financial services firm saying you have to have a number or they're free calculators to see what your retirement number is. That is meaningless. Every single person needs a different number and they vary so widely that it's not worth looking for your retirement number. It also changes year to year too because things like taxes change as well as the cost of your living. Okay. This is another one I like to bring about because a lot of companies are out there focused on selling investments. So they make it be like, if you pick the right investments and pick the right company and the right person, you're going to be successful in your financial future. Incorrect. Investments are very small part of people's success financially throughout life. It's a fallacy that's being sold by institutions that are selling investments. It is important, but it is not the be all and end all. And I have made perfectly successful plans with people that have little to nothing invested in the markets. Okay, this one I'll skip by because everybody already knows this one and because it touches upon the emotional aspect. Okay. This one I'm going to bring up because it is so important. Sorry, I keep using my hand. No, you can't see it well. Buying when everything looks rosy and great and fantastic and juicy and my gosh, I really have got to get in because everybody's getting rich. Selling in fear when things decline. Oh my God, it's the end of the world. It's never happened like this before. It'll never recover. Consistently over time, people do this. They react emotionally. Nobody likes to see the portfolio decline. It's not fun. It's not enjoyable. And if you have a properly managed portfolio and or plan, the money you need for the foreseeable future is in a safe place. I know if you're my client, that's the case. That's a critical thing there. You never want to have to sell at that sell point, not because you're scared, because you actually need the money. But this happens time and time again, the most common mistake that I see. This one, I love this saying, investing based on past performance. Sometimes new clients will look up the recommendations I make, say in Morningstar and say, hey, this one only got a 3-star rating. I don't know if I want it. I said, I don't care what it did before. I care what it's going to do going forward. That's what matters. So past performance, looking at past performance is like driving, looking through the rear view mirror. It doesn't do any good. The markets will not be the same in the past as it will be will not be the same in the future as they were in the past. You want to know is what will be most likely to do well in the future. Okay. This one's fun too, because the question I get all the time is, how can I buy the next XYZ? I'll say Apple. How can I get the next Apple, the next Tesla, the next Amazon? All the major venture capital invest a tremendous amount of money in many, many, many companies, knowing that one of them may hit it big and the rest will fail miserably. If you have money that you can allow to fail miserably, this is a fun strategy, but make sure it's a percentage of your portfolio that you can afford to lose, because most don't make it. And the other thing I'd like to say, and I'm going to use an example, I will pick on a company here because I'm not going to make a recommendation on it. People who invested in Tesla, as I talked about earlier, for years, had to take some significant drawdowns and some significant uncertainty well before it got to its current price. The same with Amazon, the same with Apple. You have to accept that. It's easy to look back in hindsight, oh, that company did so well. But they also had a lot of downtimes, and not everybody would have the fortitude to stand up through that time. Now, I think this one I can bring up quickly. People tend to get more conservative after a decline. It's just, oh my God, it's dropped in value. Please sell all of it, put it into cash or put it somewhere conservative. But going forward, as you saw from that dip, right, that's the time to invest. But people who sell out in fear take a long time to get back into the markets. The best thing to do is make sure you never have a portfolio invested outside of your comfort zone. And again, if you're my client and you never experience volatility, it's not comfortable, have a conversation with me and let me move things around, because that's important. Getting back in when you got out is really hard. Okay, last couple ones here. Actually, I'm going to skip past this one because I've already talked about that at the financial planning side. And I will end with the balancing it all. So let me shut off the screen share here.
So now you can look at me again. All of this I brought up today, and I went through it rather fast because I really love to have these conversations more in person, was hopefully to maybe rethink some of the ways that you or other people in your life think about money. This is a great thing, again, to share with people that maybe have been having challenges around the investing or the planning aspects of it. Money is a part of our lives. It is a tool in the material world, and understanding it and using it properly gives us the greatest amount of freedom. I will help anyone who reaches out to me. I'll do my very best to answer questions, but first and foremost, and my priority is always to my clients. So know that I am here. Know that anything that I say in any of these webinars that you heard today, anything you hear on the news, and anything you hear from others is available anytime to talk to me specifically and personally about. Okay? I am here for you. I care deeply, and I am here to serve, especially during these times and in all times. I take very deeply the responsibility in which you've entrusted me with, in most cases, your life savings. And thank you, and thank you very much for that confidence, especially given all the uncertainty in the world right now and whatnot. So I Very much appreciate you coming to these webinars. I will continue to do them as long as they're valuable. Does not replace in-person or face-to-face meetings, and yes, people are coming in person now. If you have any questions, follow up with me. Again, in 2 weeks from now will be a detailed look at the economy. Maybe I'll throw some other fun stuff in there depending on your requests, so keep them coming. One after that, elections and the economy. Thank you all very, very much, and I look forward to seeing you again in 2 weeks if I don't talk to you sooner. Bye for now.